Okay. So we're about to start now. So the name of this webinar today is Tax Talk 2025. Let me first introduce myself. I'm Onyenye. I think the previous introduction is more than enough. So I'll be walking you through the Nigerian new tax framework, which is called the Nigerian Tax Act 2025, which introduces harmonization, simplified compliance, and your new tax reliefs. At the end of this session, you should not only understand the key reforms, but also how they apply to you as an individual, as an SME, or as a company. So these are the outlines. The latest tax reform, will explain it for you, the personal value-added tax, company income, capital gains tax, and withholding tax. The exemptions and release for the SMEs and individuals. The tax harmonization, that's the single tax window. In Nigeria, we operate a single tiered tax system to eliminate double or multiple taxation. Digital tax compliance, electronic invoicing, tax identification numbers. Then the challenges are ahead. What are these challenges? How we transition, the enforcement gaps, or the compliance costs. Then the opportunities, incentives, and deductions. Then we'll talk about the way forward. At the end of this session, we'll give time for questions and answers. So you can ask any relevant questions you want to access, right? Okay. So the tax reform updates, this was signed on 26th of June by the President Bola Ahmed Tinubu. 4 tax reform bills into law. The first one is the Nigerian Tax Act, the Nigerian Tax Administration Act, the Nigerian Revenue Service Act, and the Joint Revenue Board Act. They are collectively referred to as the Act. FIRS is now renamed to Nigerian Revenue Services. Basically, it's just to eliminate double taxation, because previously FIRS collects the company tax while the state tax board collects the state tax. So now everything is now called Nigerian Revenue Services, so that your tax can be netted off with each other and you get to avoid paying double taxation, right? That's just the whole essence of it, one of the essence. So now, the Nigerian Tax Act consolidates over 20 different tax laws previously. They are modernizing it into one core tax provision. Then the Nigerian Revenue Service Act establishes the Nigerian Revenue Service as a central body to handle all tax collection and management, the same thing I talked about. So it's the Nigerian Revenue Services that's going to handle all tax-related matters from next year. Then have Joint Revenue Board Act. They now facilitate the collaboration between the federal and the state government to harmonize this revenue collection. While the NRS handles the collection, the management, there's this Joint Revenue Board Act who does reconciliation back end. They do the collaboration between the federal and state government to ensure that this tax is being harmonized. Next slide. We have the taxation of individuals. The Nigerian Act specifies that tax shall be imposed on the income of any individual earned in Nigeria, whether you're resident or non-resident. Let me put a clarity on this resident and non-resident. For residents means that you're already living in Nigeria. Once you spend up to 3 days in the country, you're already a resident of Nigeria. So you're eligible or liable to pay tax, right? Then non-resident means that you don't live here, you don't reside here. Maybe you're abroad, or you're not in Nigeria basically, but you earn income in Nigeria. So you're non-resident, but you're earning income in Nigeria. So you're still subject to Nigerian tax laws, right? So this scope of tax for today is cover the following: individuals and employment, or you're self-employed, whether you're a business name or an enterprise, whether you're a partnership, whether you trust or an estate, or non-resident individuals. But that's for this taxation of individual. And the next slide. Taxable income. Taxable income is the aggregate amount of accessible profits from trade, business, personal, or vocational. So when we say taxable income, this is totally different from your tax, right? So it's not your profit, sorry. So it's not when we say taxable income, people just assume that maybe it's my sales or my profit, whatever I make as my profit, that's what's taxable. No. Your taxable income is different from the profit you make as a business or the income you earn in employment, right? The first one is accessible profits from any trade or business. Whether you're a shop owner, you're a consultant, you're a tailor, lawyer, or you run an online service, as long as it's an income earned from providing value. Then the next is employment income, right? That's your salary, your wages, your allowances, your bonuses. The total of them is what we call the employment income. Anything you earn as an employee. Then we have the investment income. That's income from investing activities. Example, your dividends, your interest from savings, or the interest from bond savings, sorry, the bond interest totally exempt from tax. Your returns from your shares or your mutual funds, they are taxable because they are earnings from money that is working for you. Then the profit from any other source, we say digital assets like your crypto or your forex trading. For crypto, the tax is done on your profits and not on your crypto gain. So the previous tax law for crypto, we just tax gain. Once this particular person makes gain from crypto, it's subject to tax. Well, now government is saying no. If you made previous losses before, you can net it off. Then you now pay tax on the income, the net gain, or you call it income. So if you have a net loss, you still don't have to pay tax. Do you understand? That is the way it works now. Then your rental income. If you have properties that you rent to individuals or whoever and you make an income from it, you're liable to tax as an individual. So when people sometimes ask, oh, I earn salary and have side businesses, you have to report it together. Or when filing, report it together. So you're going to be taxed on your side hustle and you're still going to be taxed on your salary differently. There are several eligible deductions. The first one we have is the National Housing Fund. This isn't compulsory any longer. Previously, I think 2 years back, it was compulsory that your employer remits 2.5% of your basic salary to the National Housing Fund. This is being used to assess mortgages, kind of affordable mortgages, subject to they have the reflows, and that's a different slide altogether. Then the National Health Insurance Scheme is 5% of your basic salary. Then the pension contribution is maximum of 8% on your basic housing and transport. We have two types of pensions. We have the employee and the employer pensions. So for the employer pensions, your employer remits that on your behalf. It's 10%, right? But for this one that is called the employee pension, the one you pay on your behalf. So it's 8% of your basic, your housing and your transport. That's the maximum. You can do 7%, you can do 8%, you can do 7.5%. But for the maximum eligible deduction is 8% of your BHT, basic housing and transport. Then interest on loans for developing an owner-occupied resident house. You know how you get loan from the bank or mortgage firms and you're developing your own owner-occupied residential house. These are subject to the Act so many, well, let's say exemptions. Like you can't claim for maximum of 2 houses in 5 years. So you can claim only 2 houses in a 5-year period. So for interest on loan is that for this money that you borrow to build this house, once it's your own personal house, it's owner-occupied residential house, your interest totally exempt from tax. Is to be deducted, not exempt. So you're getting a relief on it. You're deducting it from your income, which means that you pay a lower tax. Then the life assurance premium on yourself or your spouse. So now, if I want to reduce my tax, so I'm like, okay, let me go and do a life assurance premium with one of the insurance firms. That amount I'm paying to the insurance firms as my premium is totally deducted from your income. So these are the ways that you can actually reduce your tax coming next year, so that you ensure that you pay the minimum tax as possible, right? Then rent relief of 20% annual rent paid, subject to a maximum of 500,000, whichever is lower. So this is reversed to the people that earn high, right? So then you can ask this rent, but if I just declare, if my rent is not up to 2.5, it's 101M, and I'm like, I want to take advantage of the whole 500K that government is giving us as deduction, and I want to declare that I want to take the rent relief of 500K. So I'm going to declare that my rent is above 1M. Don't forget that tax is two-way part. The giver or the receiver, or you say the buyer or the seller, both of you have two intents. Basically, just to reduce your tax. Nobody wants to pay tax. Like, not like you don't want to pay, like you want to reduce your tax legally, like to pay the lowest tax possible, right? So if you're stating that your rent is over 2.5, when your landlord goes to file his own tax, he's going to state that he received 1M from you. And there are penalties for all these tax evasions. There are several penalties for all of them. Some can be as high of 200% of the amount. Do you understand? So one thing about this whole tax reform is that with the reforms they're trying to put in place, it will be very hard for you to evade tax, because as they're trying to evade tax, it's going to fall on someone else who is also trying to evade tax. So it can be easily checked. Do you understand it? So you can't go and impute a high figure for your landlord that this is how much you paid him, and landlord is trying to say, oh, this is the amount I earned, it's very small, so I don't want to pay much tax. You see, there's going to be a problem somewhere, right? Okay. So next slide. So we have the exempted income. What I talked about previously was eligible deductions. What you can deduct from your income, so you can pay your taxable income will be lesser, right? To get a tax. These ones are exempt income. This means that if you earn any of this income, it's not even taxable at all. Talk more of we deducting a portion. No, it's not taxable at all. It's exempt. So first of all, is that once you earn minimum wage or less, like if you earn 800K annually in this new tax law, you're totally exempt from tax. Previously, it was 300K. So, but if you earn like minimum wage is like 75K or 72K, then it's like 840K annually, right? So it's more than that. But in the real sense, you're supposed to actually claim one deductions, all things being equal. So more like if you earn up to like 1M in a year, you're most likely never to pay tax. So you're even going to earn slightly above the minimum wage. You're more likely not to pay any tax next year, because of you take advantage of some eligible deductions, right? Then the pension or any retirement benefits, they are totally exempt from tax. Then the sum received by way of debt gratitude, totally exempt from tax. Then compensation for loss of employment, subject to a maximum of 50 million naira. So if you've been out of employment for 4 months and your previous organization, they paid you 50 million naira as termination benefit or something, is totally exempt from tax. You're not paying any tax from it. Then income you earn from state or FGN bonds, all bonds, fixed income bonds, totally exempt from tax. So when government pays you that your quarterly interest for the bonds you invested, it's totally exempted from tax. You're not paying any tax on it. So that's more like a drive to encourage people to invest in federal government bonds, right? Then dividend received from investments. I'll put a bit clarity on this. Your dividend income, you already pay withholding tax on it. So before the company even credits your dividend, you already deduct 10% withholding tax. So you receiving the income or receiving the dividend or your own part somehow is already taxed. So the income you receive as dividend, you're not going to it's totally exempt. You're not going to declare it for tax purposes again. Do you understand it? That's the way it works. Then wages and salaries of military officers, this one they are exempt because they're serving the nation. Okay. So these are the previous old tax band, and this is the revised tax band. It's very straightforward. Previously, the tax was 24%. That's the maximum amount that can be charged on your taxable income, but now it's 25%. Funny enough, this revised tax band, for most people, the middle and lower income earners, the revised tax band is more lesser, they pay lesser tax. Like when you calculate your effective tax paid, effective tax is actually lesser than the previous band. But the problem is that most people are not even paying tax. I don't want to say they're not paying tax at all, but they pay some informal taxes. You know how some people will come to the market to me and they're telling them pay this amount, and they even pay a lot more than the people that work that actually file tax in the proper way. So, but aside that, if you're paying tax previously and you're middle or low income earner, all things being equal, your effective tax rate now is much lower than before. So you're actually benefiting from this new tax law, right? Subject to your own particular circumstance. Example, that rent relief, if you're living in your house and before you're eligible for consolidated relief allowance, but now there's no consolidated relief allowance. So there might be a slight difference in yours than any other person. Do you understand it? So this is the way it's calculated. It's calculated on a progressive basis. Let me go to the next slide. I think I have an example. Yep. So now we're going to start. Let's assume that you earn 500,000 per month as your income, personal income, your salary, your pay. That's your 6 million naira annually. Let's have this assumption that your 40% is your basic, 35% is your housing, 25% is your transport. That's 2.4, 2.1, and 1.5 respectively. Then you did not, I'm just assuming that you didn't contribute for any life assurance because the country we live in, most people don't really pay life insurance premium. Do you understand? I'm also assuming that you didn't take advantage of the National Housing Fund because in reality, the 2.5% of your basic, by the time you want to get the house, the cost of the house is even far more ahead than what you've contributed. Do you understand? So some people opted out not to continue with this contribution. So I'm assuming that you're not contributing that, right? But your case can be different. Then have the tax allowable deductions. That's the employee pension, 8% of your, when I talked about employee pension, 8% of your basic housing and transport, that's 480,000. Then have the 5% of your basic for the NHIS, National Health Insurance Scheme, that's 120,000. Then have the rent relief, 500,000. Yeah, I'm assuming that your rent is over 2.5 M, so you're claiming the 500,000, right? Then for total reliefs, we have 1.1 M. Don't forget that your taxable income is 6 million naira annually. So when you reduce the reliefs 1.1 M, you have 4.9. That's now your taxable income. That's where you apply your tax on. Did you see the way it works? We didn't apply the tax on the whole 6M. You have to take advantage of some eligible deductions to reduce our tax. I forgot to add here that the one of interest on owner-occupied house is an eligible deduction. So if you took mortgage or you took loan from the bank to build a house or to buy a house and you're paying interest on it, that interest, you need to deduct it. Is a liable deduction. Do you understand it? Subject to maximum of 2 houses in 5 years. Yep. The next slide. So now, see the way it works. The first 800K is 0. So you're not even paying tax on 800K. Don't forget that what we have is 4.9 M. So when we subtract 800K, we should be having 4.1, right? Then the next 2.2 is what? 15%. That's 330,000. So what we have left is 1.9 M. You know it's 4.9 that we're applying the tax on. We've already taxed 2.2 plus 800K. That's 3 M. So we have 1.9 million left. That will be taxed at the next band, 18%. That's 342,000. So total tax that you're going to pay annually is 672,000. That's like 56,000 monthly, right? Then your net pay, that's your take home, that's your gross income less tax, NHIS, pension, rent, NHIS and pension, everything is 4,728,000 annually. That's 394,000 monthly. So that's what you take home. You're earning 500K, but after all your pension deduction, your tax, deducted your NHIS, what you have left is 394,000 monthly. But actually, in the actual sense, or in the real sense, it should be more than 394,000. Do you know why? Because this pension is still your money. Just like you can't access all of it. There's some pension reform acts. There's a lot of rules around it. Do you understand it? You have been out of employment for like this number of months. You can access, I think it's like 40% or something. But overall, it's still your money and it's earning interest because the fund managers, the pension fund managers, they invest this money in qualifying investments. That's not the scope of our topic today. So you're actually earning more than 394,000 indirectly. But what you take home as for now, today, this is your take home, 394K monthly. Yep. So now, I cannot pay tax. I'm going to pay very little. Government will accept your claim, but they're going to verify it or authenticate it using your bank statement, which is linked to your BVN. You know, right? So they're going to say, oh, you said you earned very little. That's what you filed as your tax. But just travel to this country within the year. So how are you able to make the income that is in traveling? You still have the benefit of doubt to explain yourself. You can say it was gift, it was whatever, however you were able to travel. But don't forget that, like I said, the tax is in two ways. As you're trying to evade tax, somebody in the receiving end is also trying to evade tax. Do you understand it? So what does that mean? Is that you saying that, oh, it was a gift, they're going to trace source of that gift. Was the person actually declared? Was it taxed? So what I'm trying to say is that for when you put something or you're trying to like reduce your tax, you have to also ascertain or ensure that you're not also implicating someone, because obviously you're going to implicate someone else, and have to be certain that whatever you say is the truth, kind of. Then the next question is, how will I claim rent relief if I'm not paying up to 12 million naira as rent? Like the same thing I talked about is that's the maximum. So you 20%, the lower amount. So if your rent is 1 million naira, you pay 20% of it. That's 200k. Do you understand? No, you pay, sorry, you claim 200k. That's the 20% of it. And that's just the way it is. That's the law. You can't claim the maximum if you don't pay rent up to 2.5. And like I said the same time, that you can't even maneuver it and declare a wrong rent figure, because your landlord is still going to pay tax on the rent that he received. And he won't like to pay rent that he did not, tax on rent that he did not receive. It's not possible. So now I'm a student with no job. Will I pay tax in 2026? You don't need to pay any tax because you don't have any source of income. That's straightforward. Then if I'm a citizen of Nigeria but not resident, with the new tax law affects me. Like I said, if you're not resident in the country, the new tax law affects you only if you earn income from Nigeria. We have several sources of people that earn income from Nigeria. We can call the dividend income, the rental income. You're going to pay tax on it. If you have any other investments, you pay tax on it. So you have to earn income from Nigeria for you to pay tax in the income you earn from Nigeria if you are not resident. That's the way it works. So some people that are abroad, they are scared, they are complaining, government won't start taxing the money in our bank account. It doesn't even work that way. Do you understand? It's only if you earn income on it. Because the money is sent from abroad is already being taxed in Nigeria. So there's no how government wants to apply double taxation on it. It doesn't make any sense. It's only if you're earning the income in Nigeria, right? Then I run a one-man business. Do I pay personal income tax or company income tax? Once your business is not a company, you're paying personal income tax. Now it's called individual tax. Previously, it was called personal income tax. That's what you pay. You do self-assessment and you file your tax. That's how it works. Then, why will I pay tax on the loan I borrow from Fair Money? Interest on loan is tax exempted. And that's another reason why they can't even charge the money. You can't pay tax on the money in your bank account. But if government is saying you having 30M, 100M inflow in your account, it's loan that you took from a loan house or loan agency, there's no how you be taxed on it. Do you understand? So that's the way it works. Then should I upgrade from a business name to a limited liability if my annual sales is below 50M? So this is a bit confusing. The two acts, one of them states 50M, one states 100M, but for this slide, we chose 50M. So if you upgrade, should you upgrade from a business name to a limited liability company? Actually, it depends on what's your business at the moment. So you understand your business structure, you understand where you are. Like I said, if government is giving us an incentive as small business owner, why not take advantage of it? But I have to be certain that I'm a small business owner. Do you understand? Because most of your sales are done electronically. Do you know what that means? Is that you can't easily avoid or evade tax. Do you understand it? So I can't come and say, oh, let me upgrade to a company because I want to declare low sales figure. Everything is going to be traced or tracked. And with the new level of what is artificial intelligence, it's easily to the system will just like throw out or the indicators, do you understand? Or they'll put some key indicators in places that can easily identify suspected tax defaulters. It's not like it's a manual thing those days that they'll be looking for you, or maybe you put your company somewhere, you don't want to put your name on the body of your company, like just make it look like it's a small company because you don't want people to think that you're making so much. No, now it's most of our sales are done electronically. People don't even use cash in the urban areas. Maybe rural areas, fine. But to an extent, we are improving, right? So it's easier to track your sales. What am I trying to say is that if you're certain that your annual sales is far below 50M or 100M, depending on when they finalize this act and they release the final version, they will not ascertain if it's 50M or 100M. We are going with 50M, right? If you're certain that it's far below 50M, and that's where most of Nigerians fall into. Either ways, like a whole lot of percentage of Nigerians, their businesses, they don't make up to that, because making 50M in a year sales means that every month is like 4 point something, I think 4.6 or so. That's what you actually make as sales. Don't forget that this is on sales, not on your profit. Some people think it's profit. That means that, oh, I'll now start reducing all my qualified expenses so that my profits will not be below 50M. No, it's on your sales. It's on the gross sales before any deductions. This is what I sold for the year. If it is below 50M, I'm totally exempt from tax. But I'm still going to file my tax stating that, oh, this is my sales for the year. Do you understand? So it's not like, oh, because I'm exempt, I won't file my tax. No, you would still file your tax. Makes sense, right? So you're still going to file your tax stating that you are exempt from tax. Then I just want to add this one that trending online. People say, how do I get my tax ID, register for tax ID? I'll drop the link. I'm going to drop 2 links on the chat box. One of them is how to calculate your personal income tax. So based on the calculation that we did, everything that we talked about, pension, rent relief, NHIS, you can actually do that on your own. Within 2 seconds, it brings up the tax you're going to pay. And the good thing about that link is that it tells you how much you were paying previously and how much you're paying now. So you could actually see the difference if you're a middle or low income earner. But for the high income earners, they are paying more tax now to be compared to the previous one. Do you understand it? So how to get your tax ID, like I said, for an individual, I'll drop the link, the joint tax board link. When you go there, put your BVN, your date of birth, I think your name, then you submit, you fill your details, address, then you get your tax ID. I think they're trying to harmonize it. That's on the tax harmonization part. One thing is that they're trying to harmonize it so that your NIN will be linked to your tax ID, or your NIN will be your tax ID. Depending when they are done with the reform, they'll issue a statement or a whatever on it. Do you understand? So, but for now, that's how to get your tax ID or to register for your tax ID for an individual. Do you understand? Once you're 18 years and above, you should have a tax ID. That doesn't mean that you're going to be taxed because you don't earn income if you don't earn income, right? So that's how it. But for the FIRS, that's for the company. How to get your tax ID is that I think the 2020 Finance Act, all companies, if you even open a bank account, you should have a TIN, tax identification number. They even had to mandate for the previous ones that have opened before 2020 to get a TIN, and it's mapped to their bank account or tied to their bank account. Do you understand it? So for any business or corporates, I think everybody has a TIN. This should be for the individuals that should be asking how I can get my TIN. Do you understand? So I think that's basically the likely questions. And at the end of the session, if you have any more question on the individual tax, you can ask us and we will answer, right? So let me go to the capital gains tax. That's the next section of this training. We have the capital gains tax. So now let me ask, what are capital gains tax? You know how people like capital gains tax? The word gains means that it's not on your profit. You gained on something. Do you understand? It just applies to disposal of assets. That's your sale of assets. So when you sell an asset and you make gain on it, you're liable to capital gains tax, right? So it's not on the sale value, it's on just the gain. So it's not like, if I'm selling this land for this amount, I'm going to pay tax on it. No, you're going to pay tax on the gain. It means that you're going to net it off with the amount that you bought the property previously. If I buy a property for M and I'm selling it 5M, I'm only paying this capital gains tax on the 1 million naira. Another thing I want to bring to our notice is that even your digital assets, that's your crypto, if you make gain on your crypto, you're paying capital gains tax on it. Do you understand it? I know percent, the next 2.2 is 15%. That's a progressive tax rate ban, right? So now the rate has increased from 10% to 30%. Previously 10%. You'll be wondering, oh, why this increase? Why the government wants to tax us more? It's not just like that. It's not on the surface, right? they're trying to align it with your company income tax rate to ensure parity and discourage companies from classifying business income on asset sales to enjoy a lower tax. Do you understand it? So previously, some companies, because they don't want to pay this capital gains tax, they reclassify their a business income as an asset sale. Instead of this asset is your business, that's your core business. You can be selling a land as your core business. You're not paying capital gains tax on it, you're paying company income tax. Check. Yeah, that's how it works. So for another person that is not my core business, it's not my core business, I'm paying capital gains tax on this. What most companies is that this asset, their core business, right? They're just trying to maneuver, I don't know if I'll say, or take advantage of the loopholes in the legal tax system. So they're going to pay capital gain because it's 10%. They declare such assets as non-core business, right? So now it's no longer 10%. So you can't reclassify it. Just put it under your business income and take advantage of your whole tax exemptions or tax relief applied to you, to the company. You understand? So for individuals, it's no longer 10%. I said it's now progressive and personal income tax band. So if you're an individual disposing an asset, your gain is taxed the same way you tax your income. That's example, like if you had made that gain of 1M I talked about selling a land, the 800K is totally exempt. The remaining 200K will be on the 15%. So in a way, I think it's even better because before they apply 10% on the gain, but now is on progressive tax basis. Do you understand it? So that is it. So, like I said, it was raised to close loopholes and to increase fairness so that small earners are shielded, so the high value transactions will contribute more. The only thing about the progressive tax band, like I talked about previously, that it just shields low and medium income earners, right? The low income earners, they benefit from this new personal income tax band to be compared to the previous one, right? So for using the same progressive tax rate for this capital gains tax, before 10% on my 1 million naira, I should have paid 100K, but now they've exempted a whole 800K. So then I'm going to pay 15% on the remaining. I'm paying 15% on the remaining 200K, right? Which cannot be up to the 100K I should have paid before. Does it make sense now? So it's actually better. So I'm going to pay maybe 30, I think 50% of 200K should be 30K. That's what I'm going to pay in this new law. So that means that if I make, for the small earners, I just dispose little asset and just make little gains on it, that makes sense for you, that this is actually better off for you. Then for the exemptions, so small companies are exempted from capital gains tax. So as a small company, you're not paying company income tax, you're not paying capital gains tax. That makes sense, right? For the assets that you bought in your company's name. Then if you transfer shares and the share is less than 150M a year, you will not pay capital gains tax if your gain is below 10M. Right? So there are two things. If the shares are below 150M, that's one. You're not going to pay tax. But also consider if your gain is below 10M. If it's above 10M, you're paying tax on the excess of this 10M, not on the whole 10 million naira. Does it make sense? You're paying tax on the excess of 10 million naira, not on the whole 10 million naira. Then the sale of residential property. Once you sell where you're living, your residential property, you won't pay capital gains tax, subject to there's some reforms around it or acts around it. So it's not like every year you come and say, this is my residential property. Next year, this is my residential property. Next 3 years again, I'm selling my residential property. No. Then your personal motor vehicles, maximum of 2 cars per year. So if you sell 2 cars per year, you're totally exempt from capital gains tax. Once you sell more than 2, assume that that's your business, you're trading with it, so you're going to pay capital gains tax. Don't forget that it's on the gain, the netting of the amount you bought this asset and the amount you got when you sold it. And if you made a loss, you're not paying any capital gains tax at all. So that is it. Then we talked about everything. So the next one. So my colleague Ugo will take care of the company income tax. So I'm going to stop sharing from now. Don't forget, like we said, at the end of the session, all your questions, we'll answer all your questions at the end of the session. Right? So now I'll stop sharing for her to share her own screen and walk you through the company income tax, the value added tax, withholding tax, and other one. Thank you.
Right. All right. Thank you so much, Ms. Onye. You really did justice to the new tax reform. I'm so excited. You brought a lot of wealth of information to us, and I believe that we all have benefited from the information you just shared. So at the end of the section, we'll be coming back to you with some questions because I'm noting down a lot of questions that we need more clarifications on. So I'll be handing over to the next speaker, Ms. Ugochi. So thank you.
Okay, thank you very much. Thank you, Onye, for such a wonderful session. I hope everybody can hear me.
Yeah, we
Please,
can.
can you hear me?
Yes, yes.
Okay. So yes, I'll be taking over from here and speaking now on company income tax. So basically, what is company income tax? This is the tax that is usually charged on profits of companies registered in Nigeria or foreign companies that earn income in Nigeria. So as long as you are a registered company in Nigeria doing business in Nigeria, your profits are subject to company income tax. And even if you're not a resident, if your company is not residing in Nigeria, but for some reasons you have some dealings with businesses in Nigeria that earn you income in Nigeria, you would also be paying company income tax. And when we talk about the profits, yeah, you need to understand that I'm talking about profit and not your turnover. Profit has to do with the gross income that you must have generated from that business. And gross income, which includes turnover plus other income, whether operational or non-operational income. The total income, deducting every other allowable expenses, that is what becomes your profit that will be charged to company income tax. And just so you know, allowable expenses has to do with your operational expenses, that's the expenses you incur in running the business. You can also get some reliefs and allowances like the capital allowances, especially for qualifying assets. And that can also help reduce your accessible profit at the end of the day. So it is that profit you get after these eligible and allowable deductions that becomes charged with based on the company income tax rate. So what is existing currently now is that companies are divided into three main parts, which is the small, medium, and large companies. And based on that, they have different rates applied to them. Small companies is regarded as companies that have a turnover of less than 25 million naira and below. And for medium-sized companies, their turnover are between 25 to 100 million turnover. And for large companies, are companies that do turnover of above 100 million. And as it is, their rates are charged at 0%, 20%, and 30% respectively. That is what is currently existing. But based on these new tax laws, the threshold has been changed to, especially for companies, small companies. Please, I'm trying to. Okay, sorry, I'm trying to go to the next slide. So now for the thresholds, like I said before, for small companies, it has been expanded. So now they've taken out having a gross turnover of 50 million naira and below, but assets is above 250 million naira. You are not a small company. So these two conditions must be met. What if you have a turnover of 50 million naira and above, even though your fixed asset is lower than 250 million naira, you are not a small company. For you to be regarded as a small company in Nigeria to enjoy company income tax exemption, you must have both your gross turnover to be below 50 million naira and your fixed assets should also be below 250 million naira. Moving on, the new tax act also introduced what is called controlled foreign company rules. Basically, this is a rule that tries to stop companies from using foreign subsidiaries outside of Nigeria to avoid paying taxes in Nigeria. So most companies, especially Nigerian companies that controls usually more than 50% of a foreign subsidiary that pays little tax abroad, what they do is they try to hide in such countries because their tax rates are low and we want to refuse send back their share of profits here to Nigeria company, which would normally be subject to company income tax. But now what the rule is saying is that so long as you are a Nigerian parent company that has a control that controls a foreign subsidiary abroad, even though your profits that you have earned abroad is not sent back, even though you do not share send it back in form of as a form of profit here in Nigeria, so long as you have declared that you have earned that profit will be subject to tax and you cannot hide from it. So the idea about this is to prevent companies from shifting their profits abroad in order to enjoy the regular tax avoidance rules. So this is trying to bring every company into the tax net and to ensure that there is fairness, especially when it has to do with large companies. There is also a new introduction of the new tax act as it has to do with companies, and this is called the minimum effective tax, aka top-up tax. So what does this mean actually? So for companies, especially Nigerian companies who are members of a multinational groups with aggregate group turnover of 750 million naira euros and above, or if you are not a member of a multinational company, but you are a Nigerian company, a big company that has 50 billion naira turnover and above, you are subject to what is called the minimum effective tax. So let us look at it individually. You are a company who is a member of a multinational group. No matter where your company or your business is operating outside of Nigeria, you must pay at least the minimum tax rate of 15%. So if for any reason what you are paying, your tax rate, your effective tax rate outside of Nigeria is not up to 15%, your Nigerian company here will pay what is called a top-up tax. So let's say, for example, your foreign profits, what you earned from your subsidiaries outside of Nigeria is the effective tax rate is 5%. So Nigerian company here must pay the top-up tax of 10% to make sure that it is up to 15%. And this is also helping to prevent companies from shifting profits where tax rates are very low or to countries that have a lot of tax holidays. So how about if you're a Nigerian company that is not a member of a multinational group? Many times big companies try to have a smart way of reducing their effective tax rate because they are large enough, they have the ability to enjoy some reliefs and allowances. So at the end of the day, they may be paying rates based on a rate that is lower than the regular 30% that should be charged on them. But what the new tax is saying is that if after you have enjoyed all your reliefs and allowances and your effective tax rate is below 15%, you must pay a top-up tax to ensure that it must be up to 15%. For example, if your company at the end of the day, after your tax rate, your effective tax rate comes up to say like 10%, there must be an additional top-up tax of 5% to ensure that it is 15%. And what this is trying to ensure is that it's trying to ensure fairness and ensure that profitable companies also contribute a minimum tax share to government. So what exactly is effective tax rate? How do we get or generate effective tax rate? Because this is not, effective tax rate is basically different from the tax that is that's the applicable tax rate for companies. The actual statutory tax rate for large companies is 30%. But like I said before, companies, due to allowances, due to some incentives, can have an effective tax rate below 30%. And how do you calculate your effective tax rate? It is basically your tax expense, which you must have at the end, after calculating based upon your assessable profits, what you have decided to be taxed to be paid to government. That is even after your current tax and your deferred tax adjustments that comes as a result of timing differences based on your capital allowance and depreciation. So that tax expense divide by your profits before tax is what you call the effective tax rate. And it is that effective tax rate that the government is saying must be at least up to 15%. So you cannot hide from it. Now let's move forward. So we're also talking about how these new tax laws have tried to bring tax harmonization and also to reduce multiple taxation. So one of it is from the introduction of development levy. So before now, we know that even after paying our company income tax, our profits are also subject to other form of taxes like the education tax, information technology levy, the National Agency for Science and Engineering Infrastructure levy, and the Police Trust Fund levy. So all of these are still paid by companies even after paying the company income tax. But with this new tax act, it is trying to harmonize all these additional levies into what we call the development levy. So for now, that development level is at 4% of their accessible profits. So after paying your company income tax, you now pay a single development levy of 4%, which also tries to reduce so many complexities with all these additional levies that used to be in place. So now let's move on to value added tax. So there have also been some changes lately in the value added tax. But first of all, what exactly is value added tax? So this is a tax, a type of consumption tax that is charged on goods and services at each stage of production and distribution. But the final cost is borne by the consumer. So let me do a bit of explanation here. So normally, when you buy goods, or let's say for a manufacturing company now, let's look at the supply chain from manufacturing, distribution, wholesaler, retailers, and final consumer. So a manufacturing company who is selling to a wholesaler will charge VAT, value added tax, on his product. So that tax, that value added tax that is charged by that manufacturer because he is selling, is called the output VAT. But for the wholesaler that is buying from him, that VAT becomes an input VAT. So because input VAT is the VAT that you when you buy goods and services, my output VAT is the VAT that you charge when you sell goods and services. So a manufacturer is selling to a wholesaler. For the manufacturer, it is an output VAT, but for the wholesaler, it is an input VAT. So that is one side of the supply chain. Now, let's say wholesaler now sells to the retailer. So when the wholesaler is applying VAT on his own sales to the retailer, for the wholesaler, VAT, but the retailer that is buying from the wholesaler, it is an input VAT. But don't forget that at the time the wholesaler was buying from the manufacturer, he also had an input VAT based off on the VAT he paid to the manufacturer. So what he will now do is to net off that VAT that he would be charging the retailer, include it as an input VAT for which you can get reliefs from. Zero rated essential goods and services. So what this is saying is that essential goods and services like the basic items, pharmaceutical products, and so many of these goods. Before now, those goods are regarded as VAT exempt, meaning that you are exempted from charging VAT. And for that reason, any input VAT that you are charged as a pharmaceutical company, you cannot claim it. Instead, you add it as part of your cost. But what the law has done now is to include those goods, those essential goods, to zero-rated taxes, such that any input VAT that is charged on it would now be claimed. Like I said before, what is existing currently is that you cannot claim input VAT. If you're a pharmaceutical company, you are not allowed to charge VAT. And when you buy materials, the input VAT that comes with it, you cannot claim it. Instead, you would add it as part of your cost. But as of this new tax law, you now have opportunity to seek for a refund. Because you are not allowed to charge VAT, you cannot net it off with any output VAT. So you have the opportunity to seek for a refund from the government. So that is what the zero-rated essential goods and services explains. Then the law is also saying there must be a mandatory e-invoicing for businesses. And this is for businesses that have a turnover of 5 billion naira and above. So what they are trying to say is that you must now ensure that your system, your accounting system that you use to generate invoice in your company must be linked to that of the Federal Inland Revenue Service, so that this can be more or less monitored, and they will get a real-time update of what you are actually saying your turnover is. And as such, the ability to evade tax will be slim. So you wouldn't have such opportunities to do so. This is just to enable governments track companies who would want to run away from paying taxes. So what are the key updates in VAT? Service businesses can now claim back the VAT they pay on expenses due to the updated input VAT recovery. So, because input VAT could not be claimed on expenses and assets before, so by default, businesses that render services like, let's say, a regular professional firm, do not have what they can claim input VAT on. But as of now, that input VAT recovery has been extended to expenses and assets. So this now gives this type of businesses the opportunity to claim back VAT. And of course, this must be linked to the services for which they provide and also charge VAT on. So now, as a professional firm, when you've given out your invoice for rendering a service, you must also charge VAT, which becomes your output VAT, so that when you are now claiming back this input VAT, you can net it off. But if for any reason you do not apply any VAT on your invoice, you cannot claim what we call the input VAT. So that is clarity on that. So how about non-resident persons? Because as a non-resident person not residing in Nigeria, you would normally not expect to pay VAT on your invoices or charge VAT on your invoices. But the new tax act is saying, as long as you're a non-resident person who makes taxable supplies to a person in Nigeria, you are now required to register for tax with the Nigerian Revenue Service and include VAT on your invoice. So long as you're making taxable supplies to person residing in Nigeria, that means you're doing business with somebody residing in Nigeria, you are expected to register for tax. And for that reason, when you are charging the person, you must also include VAT on your invoice. And whereby you are a non-resident person, making supplies to somebody who is in Nigeria, because you are not residing in Nigeria, of course, it will be difficult for you to pay VAT to the Nigerian government. But how then will your VAT be paid? The law is saying you, who they are making supplies to, you, who is the Nigerian company doing business with them, you are expected to withhold that VAT. So now I'm giving you an invoice as a non-resident company, and say for 500 million naira, and I've included my VAT on that invoice. say 7.5% above it. So instead of me, the person that is buying from you, me being the resident company or the resident person in Nigeria, when I want to pay you, I will not pay you your money plus VAT. What I will do is I would only pay you the money for the service you have rendered. But you see that VAT aspect, I would withhold it and by myself pay it to the government. So that is what the law is saying. So for non-resident individuals, because they cannot remit directly to the government, you, who is the resident company they are doing business with, you are expected to withhold that VAT and pay on their behalf. So now, this is a clear example or an illustration of VAT that are goods that are exempted from VAT and goods that are zero rated. Here, the Nigeria Tax Act expands the list of zero rated items to include essential goods and services. The impact of this is that businesses selling these goods and services can recover their VAT cost despite the zero rate, which was previously not possible by law, which I've talked about before. So now, for a VAT charge to customer, if you are under the VAT exempt category, maybe your goods is under the goods that are exempted from VAT, you cannot recover impute VAT. Rather, that VAT will become part of your cost. But if your goods is under the zero rated category, you can recover impute VAT or it can be refunded to you. So for both categories, both exempt and zero rated, the VAT applicable, you cannot charge VAT based off on the fact that it is 0%. As a pharmaceutical company who is under zero rated, you can't charge VAT, so it is 0%. For a company that is under exempt, you cannot charge VAT, it is 0%. But you see that your impute VAT, the one you are paying to your supplier, when you're under the exempt category, it becomes a cost. But when you're under the zero rated category, it can be refunded or you can use it to offset your output VAT. So let's move to the next slide. These are examples of goods and services that are under the zero rated category. So we have the basic food items, which could include confectionaries, bread. There are some of all these items that have not really been processed and finished that is regarded as basic food items. So we have all medical and pharmaceutical products, including medicinal herbal products. There are educational books and materials, fertilizers, locally produced agricultural chemicals, veterinary medicine, and animal feeds. Some of these are under the zero rated category. Even if you are rendering goods, including if you are exporting goods in the oil and gas sector, electric vehicles, if you are into this type of business that provides this type of services, you're under the zero rated category. And as such, you can claim your input VAT, but you cannot charge output VAT. You can claim your input VAT, you cannot charge output VAT. And where you have no ability to charge output VAT, that your input VAT that is claimable, it can be refunded to you from the government. Now, these are the goods and services that are under the exempt category. So for these ones, you cannot claim your input VAT. Rather, it will be added as part of your cost, right? So examples of all these are goods purchased for use in humanitarian donor-funded projects. So these are basically for non-profit making organizations, charitable organizations. So for people that are into baby products, right, especially products that are between 0 to 3 years, you are under the VAT exempt category. We have locally manufactured sanitary towels, pads, or tampons. We have road transport service. So all these are under the exempt category. So for this set of people, you can not charge VAT and you cannot claim input VAT. Rather, you add it as part of your cost. So now the Act also introduces what we call the reverse. It's saying even if a company has, for any reason, not charged VAT when they are rendering service to you and giving you your invoice, that you are expected to self-charge yourself VAT and pay it to the government. In the event where you do not do so, of course, there are penalties that are attached to it. So now, the digital tax compliance, I talked about the mandatory e-invoices earlier on. So the Nigeria Tax Act introduced this e-invoices system basically for real-time reporting and monitoring of invoices. And of course, this also allows for accurate record keeping, improved regulatory oversight, and improved VAT compliance. Because, most times companies would want to find a way to evade tax. Nobody really likes paying for tax, right? But now the government is saying, so we are not going to wait for you anymore to come and tell us this is what you sold and this is what you paid. But rather, we want to be able to see real time what you are doing. So at every point in time you are raising an invoice to that your customer, the government is also getting a notification, because what they want to do now is to link their own system with the system of companies, right? And like I said before, basically companies that are doing a turnover of 50 billion naira and above. This is to also ensure compliance. And it is also the service that will determine the type of software that is required for this process to be done. And what is applicable is that if for any reason the software, your accounting software you are using now, does not is not suitable, such that it cannot be linked to that of the new FRS system, you may be actually required to go and change or upgrade your software so that it can be done correctly. So the pilot phase has commenced since the 1st of August 2025, starting with businesses with turnover of at least 5 billion naira. 5 billion naira, not 50 billion naira. And the implementation deadline for this category has also been set as November 2025. So companies are expected to start registering and start improving their system so that they can comply with this new mandatory e-invoicing system. So now let's move on to withholding tax. Withholding tax is actually an advance payment of tax, which is deducted at source on payments made for certain transactions. So basically, this is a way of trying to bring taxpayers into the tax net and also curbing tax evasion, because many times companies would not, like we all know, would not want to declare or pay their taxes. So this is a tax that helps the companies they are doing businesses with to ensure that they deduct their withholding tax at source. So at the end of the day, when you are giving me as a vendor who has rendered a service for me and you are giving me your invoice, so for your professional service or your commission that is attached to it, I would deduct a certain percentage and withhold it and pay it on your behalf to the government. So what that happens is that when you are computing your company income tax after the year end, that withholding tax, you would deduct it as a form of credit from your own company income tax, and it is the balance that you now get to pay to the government as your company income tax. So this is just an advanced payment of tax. So it is also your money technically, because I tell people most times when you say you will deduct withholding tax from their invoice, they start complaining. And I say, this is also your money. It is just that I am helping you pay your tax ahead of time. So at the end of the year, when you are filing, of course, you already have the credit to deduct against your liability that you will be paying to the government eventually. So small companies now are exempted from deducting withholding tax, except where the supplier has no tax identification number and the transaction is above 2 million naira. So the small companies, which still falls between that our band of companies doing a turnover of below 50 million and has a total fixed asset of below 250 million naira, they say these companies are exempted from deducting withholding tax. So they are not expected to withhold tax from their suppliers. But in the event that your supplier, when he has given you an invoice, you see that there is no thing on that invoice and that transaction is above 2 million naira, as a small company, you must deduct withholding tax. That exemption does not cover that aspect. They have also reduced or introduced some withholding tax reduction rates. So basically, companies that are basically into the sale of goods and services, especially for manufacturing, companies that are basically into in the ordinary course of businesses, right, have a withholding tax rate reduced to 2%. I think this used to be as much as 5% before, but it has been reduced to as low as 2%. And for companies that manufacture goods by themselves or materials supplied directly by the manufacturer or producer of those goods, they are now exempted from deducting withholding tax. So taxpayers can now issue, that's as a taxpayer, you can now issue credit notes and receipts for withholding tax deducted in favor of your beneficiary. So when you deduct withholding tax from your vendors, you can now issue them a receipt or a credit note so that they can use that to go and claim it from the government. So what is applicable today is that after deduction, the companies that they have deducted from would wait for credit notes to come from tax authorities or the government. But the law is saying, no, you who have done that deduction, give them the receipts, give them their credit notes so that they can have it as an evidence to claim back their tax. So the law is also saying that if for companies that do not have tax identification numbers on their invoices, you who is deducting withholding tax from there, you should double the withholding tax rate. So let's say a vendor who has rendered service for me has given me an invoice, and I see that on that invoice, he did not put tax identification number on it. So if normally I'm supposed to charge you 2%, but because I did not see tax identification number on your invoice, I will charge you 4%. And it is that 4% that I will take and pay to the government. And the implication is that you get to lose it because you have not provided a tax identification number for which that withholding tax will be used to be paid on your behalf. So if you don't have a tax identification number, how would they tie the withholding tax deducted from you to you? How would they tie it to you? So it is in your best interest to ensure that when you are giving out invoice, you should provide your tax identification number so that at the end of the day, the credit will come to you. And this regulation has already taken effect since the 1st of July, 2024. So these are transactions that are exempted from withholding tax. That is, goods that are manufactured or materials produced by the person making the supply. So they are exempted from withholding tax. And the regulations define manufacturing and production to include both the production of energy, electricity, gas, and petroleum products. So if you are manufacturing your own goods and you are the one supplying the goods for which you manufactured by yourself, then you are exempted from withholding tax. Across the counter transactions, which are transactions carried out between parties without established or prior contractual relationship in which payment is made on the spot. So you just go to maybe an aboki down this road and there was no previous contractual relationship. It's just that you made a payment immediately to buy whatever you're buying. Such transactions are called across the counter transactions. So those ones are also exempted from withholding tax. Out-of-pocket expenses expected to be incurred by the supplier, which is different from contract fees. So expenses that are required that you would use to carry out the work done, this is now different. They are trying to differentiate it from your contract fee. So you know that this is what I will spend in buying the items I will use to do the work for you. Those ones you cannot charge withholding tax on it. But you see that your labor, that's your contract fee. Please, let's pay attention to the criteria here. So this must be designed. So maybe you have one that cowbell milk show is basically to for children. There's mathematics competition and all of that, and they have done where they've won some gift or some money from it. Of course, that content was designed to promote entrepreneurship and academics innovation. That one is exempted from withholding tax. But the likes of those reality show that you cannot tie the content, you cannot tie how beneficial it is, especially in terms of entrepreneurship, academics, technological and innovation. Those ones, they are not exempted. So I don't know the what we will tie Big Brother reality show to. I don't know if it falls under this ban, but basically they said those contents must be designed to promote these innovations that are beneficial to the citizens. So now, the compliance challenges and opportunities. Of course, with the introduction of this Nigerian Tax Act, there are a lot of challenges ahead. There are a lot of opportunities too that we can benefit from it. And some of the challenges are the transaction complexity. So many times, especially in the case of this digitalization, which has to do with the e-invoicing system. So some companies are still struggling, are still finding it hard on how to transition, on how to move from their current accounting system to match what the government is asking for. Of course, these are going to be some challenges to them. The case of VAT self-accounting too. So some people will still find it hard to understand, oh, which one am I to charge VAT on by myself and which one am I not supposed to? So there are a lot of complexities in terms of understanding these new laws, and also there will be more expanded documentation. So now you're saying, before now, I could if I don't see VAT on my invoice that you've given to me, because I could probably hide away from it. Now, of course, there are expanded documentation because I have to self-charge myself VAT, and of course, you are supposed to keep all the records for the government to see that you have done what you're supposed to do. So there are also ambiguity in trying to understand these laws, especially in terms of effective tax rate. So many people confuse effective tax rate with the regular company income tax, and also this introduction of top-up tax. So this also cause some ambiguity in understanding the rent relief rules too, based on the subject to 500,000 naira maximum and lower of 20%. So there is need for proper understanding before this can be applied correctly. And also there can be some enforcement gaps too, because there are also a lot of informal sectors that the government may not be able to have hold on. Of course, for you to properly get all these people into the tax net, it's going to take a lot of time and a lot of systems put in place. And of course, penalties that will come up if you have failed at some point, and maybe when you do not file when you're supposed to file. And of course, many times there is tendency that there may be some compliance gap, especially when the depth of knowledge is there. So you may not even know that you have evaded, or you have not filed tax appropriately, because you do not really understand how it works. So some of those penalties may apply. So of course, while we are talking of challenges, there are also some opportunities that comes to us, both as businesses and as individuals. There have been some incentives in terms of expanded exemptions based on the company income tax rate. Now we have the company income tax threshold has also been expanded for small companies. We have the revised tax band for personal income tax. So we have a lot of reliefs and allowances too that has come in, exemptions from withholding tax, exemptions from value-added tax. Those ones too are also part of the opportunities. Then the imputed VAT recovery now has been expanded to cover zero-rated essentials, which was not there before now. So that is also an opportunity for companies to take advantage of and also reduce their tax burdens. Then tax harmonization, in trying to reduce complexities of so many taxes, right? So now, like the development levy, this has been brought in so that there is a single levy that should be applied and avoid too many levies that one cannot really understand. So what's the way forward? With this new introduction of the act and for businesses and individuals, what are we supposed to do? So the best thing for us is to stay updated, right? We should be informed. We need to do proper training and upskill ourselves so that we can ensure seamless adoption of the new tax laws, especially in roles and processes that are impacted. And that is where KDEC Professional has come in. By this webinar is one of the ways of training people and getting people informed to know what is applicable out there, and so that people can also make further research on how to comply. And of course, they also stand as bodies that can be reached out to when there are some complexities that you would need proper clarity on. So another thing we need to do is to manage change. So apart from training and upskilling, there is need for a deliberate change management plan to drive behavior, review and monitor the transition and adoption of the new rules. You now have to start thinking as a tax compliant citizens beyond how do I evade. So there is a difference between avoiding tax and evading tax. So if you can find suitable loopholes by which you can use to avoid tax, good for you, right? But it is better off than trying to evade tax by trying to, by all means, not wanting to pay the appropriate tax that you should pay. So we need to start changing our mindset. We need to start changing our behaviors as citizens, and also try to see and monitor how this transition and new rules will apply to us moving forward. So the recent act makes a significant transformation in Nigeria's tax landscape, and it is also crucial for businesses to carry out a comprehensive review of their tax strategies, processes, and compliance frameworks to ensure readiness and resilience. So the best time to start is now. So this act has been set to take effect on 1st of January 2026. Yeah, so you need to get ready. You need to start preparing yourself. You need to start knowing what you should do so that at that point in time you are ready to hit the ground running. And KDEC Professional Services has also developed a comprehensive industry analysis of these changes, right? They offer practical insights and guidance to help businesses navigate and adapt to the evolving tax landscape. So they are always there, ready and available to assist in any way possible. So for that, I think that will be the end of my own contribution. So if you have any questions, I think we can take it off from here. Thank you very much for listening. Adobe, I hand it over to you now.
Yeah, thank you so much. Thank you so much, Ms. Ugochi. It was really awesome. In fact, so many insights to be taken from here. I really appreciate you and Ms. Ibekwe. You know, we've got a lot of information from here. Before now, I believe most of us do not know the changes that have been made in these tax reforms. But going forward, we will know how to, how to prepare for the 2026 tax compliance. Then we should be able to know how to reduce our tax minimally. Not that we want to avoid it, but we should be able to reduce it reasonably. I believe most of us noted down some questions to ask. Please, the floor is open now for questions and answers from the speakers. Thank you.
Yeah, good afternoon. Good morning, everyone.
Yeah, good morning.
My name is Oladapo Musa, and I have a questions for someone in a travel agency that issue. Am I good to talk?
Yeah, sure.
Yeah. For a company in a travel agency that issue tickets. Now, we all know that in this present dispensation, Over.
Okay, so what the present dispensation is saying that such VAT that has been embedded should no longer come in that form. Now there should be a clear separation between the cost of the service and the VAT element. It should be separated, and you are expected to withhold that VAT. So it's no longer a case of you cannot withhold it. For cases of maybe individuals that are not residing here, that cannot pay the VAT by themselves, you who is being charged that VAT should withhold it on their behalf and pay on their behalf. That is why they are now expected to register with the Nigeria Revenue Service so as to be able to charge VAT on their invoices and allow you to self-withhold, to withhold it for them and pay on their behalf. That is what the new dispensation is saying. Is that clear?
Really, not really, because let me tell you how it works.
Okay.
I have an IATA,
Mm-hmm.
and being an IATA agent, I can issue ticket, and at the end of the day, the airline pay me a commission. So when I issue ticket, I have airport taxes, this, other taxes. The VAT element is embedded. Like for example, now British Airways is about 15 million naira, and when they bring out the breakdown, I only will pay a commission just on 1.5 million, which is the fair charge. You understand? And the VAT element already is there. You see it, other taxes. That other taxes, including VAT, airport tax. And if I don't pay, I will not be issued ticket. I can't issue that ticket. And I cannot because I want to issue ticket. I say I want to withhold. British Airways will drop my passenger seat. So the VAT element now, how do I tell Federal Revenue that, see, this VAT element, although in the VAT law, we have destination-based VAT. It's just like somebody going to UK, stay in a hotel, and in the hotel, you see VAT. He paid VAT in UK. Can he claim the input VAT here in Nigeria? Because it's a destination-based VAT. The same thing applies to travel agency. Thank you. Over.
So I hope you are not confusing the fact that they are supposed to. Are you the one now charging the VAT, right? Or they are the ones charging you VAT?
I'm not charging it. I'm not charging the VAT. I want to buy a ticket.
And VAT is on it, right?
Yes, there is a software called Hamados, which I will go in there and said, Ugo Ima is traveling to UK on so day. They will give me the breakdown of the fare. I paid.
Then you are expected to pay.
Once I paid, I will pay the total sum. After paying the total sum, the airline, being an agent, will not give me a commission. And that commission, for example, now, if I pay 15 million for Ugo to go to UK, the Ugo will pay me 15 million to my account. Me, I will pay 15 million to the airline. The airline will give me commission. The commission that will be given to me will not be based on 15 million. That's a breakdown. Other taxes and every other thing will have been deducted. What the airline will give me is 10% of 1.5 million.
Excuse me, sir, please. I want to ask a question.
Please go ahead.
When you are charging your customer, do you charge the customer as in, do you issue the British Airways invoice directly to them, or you use your own invoice to collect the money from the customer before buying tickets from the airline?
Okay, now I'm still going to use that as an example. You called me, tell me you want to travel to UK. I should make reservation for you. Okay. After making reservation, I said, Madam, the British airline is 50 million naira. You pay directly into my account. After paying to my account, what I will give you is the ticket that have been issued. I give you the ticket. Me, I will transfer the 15 million naira to British Airways. And when British Airways is going to give my commission will be paid on 1,500,000, which is 10% of 1,500,000. That will be the commission that will accrue to me. You understand? Now, the question is, how do VAT elements from that transaction of which it has been embedded in the ticket be remitted to FRS? The FRS now come to me and said I should pay 5%, 7.5% of 15 million. No, it is wrong.
So
Okay,
now,
sir.
okay.
Okay, please I want to get more clarification so that the question can be easily answered. Okay, sir. If you can prove to FRS that at the point of issuing your invoice or telling the passenger to pay 15 million, that you have not added any profit to that services, then I think you should be able to defend yourself before FRS. But if there is element of profit from that service, you are expected to pay.
Yes, Madam Adobe, I think I got it right now. So which means, for example, okay, sometimes, I'm sorry I'm taking your time. Sorry. Let me give you another scenario. This is what I do. Now, for example, now, Madam Adobe wants to go to US. And I said, Madam Adobe, this US ticket is 25 million, but I'm giving you a service charge of 200,000. That 200,000 naira that I have added service charge, the onus is on me to pay 7.5% as VAT, right?
Yes.
Okay, thank you. That's what I want to know. Thank you. God bless you.
Of course. Oh, yes, of course. Because you are not standing in as a middleman, right? So you get to deal with your own clients. That service charge, like you rightly said, should be the one you should charge VAT on to your client.
Okay,
because
thank you.
your client is not dealing directly with British Airways and all of that. All right. Thank you very much.
All right. Can I ask a question, please?
Yeah. Okay.
Yeah, my name is Temitope Giloba. Okay, I am both a business owner and an employee, right? My business is registered, and then it has a tax identification number, which is expected of me to use in remitting my tax to the federal government. But now, as an employee, I'm still meant to pay tax, right? On my employment offer, there is a gross salary and there is net salary. So it is expected that all the deductibles have been deducted from the gross before it's subject to paying me the nets. Am I expected, which I believe tax must have been deducted from the gross before I'm being paid, the nets. Am I expected to pay tax out of the net again, or all those must have been, taken care of by my employer? That's one. Now, as I double as an business owner and an employee, am I expected to pay different tax as an employee and separately also on my business as a business owner? If you get the question, let me answer. Thank you.
Okay. So, Onye, would you want to talk on that?
Okay. Can't pay any other tax from your net salary. Your employer has already deducted your salary. That's why it's called net. So that's the way it works in Nigeria. Once you're in employment, the law is that the tax is being deducted before you get your final net salary. Do you get? So, but the thing is that you have to get your TCC. It's called tax clearance certificate, because your personal individual tax, file tax yourself. If your employer is not already remitting the tax to government, most of all these remote workers, if your company is employed you like is not like a core employee, you're not a contractor. If you check your pay slip, most times the deducted tax access, they use some of all these middlemen to do that. But aside that, all these freelancing, the ones that you get on Upwork, they don't really do all those legal tax part for you. So you file your tax yourself. That's the reward. So you pay tax once you